John D. Rockefeller, Sr. achieved a net worth that, adjusted for U.S. GDP, equates to $400 billion in modern terms, making him the wealthiest American in history. This concentration of capital is the first numerical fact. His operational success was predicated on eliminating market fluctuation, famously stating, "Competition is a sin." The structural consequence of this aversion to competition was the invention of the trust form in 1882, an opaque legal mechanism that pooled $40 companies under 9 trustees, essentially making a $70 million capital entity impervious to external market forces. The second numerical fact is the $90% market share Standard Oil achieved, which was not just an industrial monopoly, but a financial chokehold. The modern financial trap is the direct systemic legacy of his anti-competitive framework, a system optimized for institutional permanence and extraction, not for market dynamism. This financial architecture ensures that capital remains concentrated and competition is managed, not free. This is the financial historian, where money, power, and history collide. Nothing is ever as simple as it looks. The trap is institutionalized stability. To understand the financial trap, we need to start with the foundational mechanics of Rockefeller's financial ascent, which were not primarily industrial. Rockefeller recognized early that the risk lay not in the oil exploration, the highly volatile and speculative segment, but in the refining and transportation, the bottleneck. By focusing solely on oil refining, he targeted the stable, controllable cost center of the industry. This analytical move was the initial structural innovation. His core strategy, applied first in the 1872 Cleveland massacre, was financially ruthless, achieving complete horizontal integration, monopoly of refining by leveraging apparitute vertical integration, control over the means of transport. The pivotal dark secret was the austere railroad rebate and drawback system. Standard Oil negotiated a secret deal with the major railroads serving Cleveland, agreeing to ship vast guaranteed volumes in return for a substantial discount on their own freight rates, the rebate. This was standard leverage. The structural weapon, however, was the drawback. Standard Oil received a kickback, on every barrel of oil shipped by its competitors. This meant that every unit of output produced by a rival subsidized Rockefeller's market expansion. This mechanism immediately converted competitor revenue into Standard Oil capital. The rival refiner was not just selling a product. They were generating revenue that flowed directly into their antagonist's ledger. The system was designed to mathematically ensure that competition was not viable. When rivals realized their own business was financing their destruction, panic ensued. Rockefeller then acquired $22 of $26 Cleveland refineries in 6 weeks, often paying the lowest possible price. This was not the result of better technology. It was the result of a perfected predatory financial structure. The invention of the trust in 1882 codified this anti-competitive dominance into a legal framework. By pooling the stock of some $40 affiliated companies under 9 trustees, the trust created a centrally managed massive capital entity that could operate as a single financial unit while maintaining the legal fiction of separate corporate entities. This invention was the prototype for the modern holding company and the conglomerate. It allowed for the unlimited concentration of capital and veto power over disparate industrial assets. This was the real shift. Rockefeller demonstrated that controlling the financial structure of an industry was more powerful than controlling its physical output. This structure created permanent barriers to entry. The $1 million in seed capital that formed Standard Oil in 1870 was unprecedented, allowing immediate scale advantage. The resulting structure, controlling $90% of the U.S. refining market, allowed Standard Oil to enforce standardization and control every aspect of the supply chain, from owning white oak timber forests for barrels to chemical labs for byproduct exploitation. Confidence became currency. The numbers told a different story. While the price of kerosene dropped significantly due to efficiency, the profits, the financial surplus, were captured entirely by the trust, generating the immense capital pools that would eventually reshape banking and politics. The financial surplus was not distributed as wages or reinvested in competition. It was accumulated into a reservoir of power. The trust became the first machine for limitless capital accumulation, proving that the scale of capital itself creates its own self-reinforcing financial laws. The battlefield became the balance sheet. The transition into the modern financial trap requires tracing the legacy of the trust into the 20th century banking and credit structures. The financial trap you're living in is the systemic replication of the trust's logic, achieving total control over the means of capital, not the means of production. This is colder, sharper, and institutional. The key Rockefellerian innovation that defined the modern financial landscape was the strategic pivot from industrial monopoly to banking control. John D. Rockefeller, Sr. and his descendants, most notably David Rockefeller as head of Chase Manhattan Bank, understood that immense industrial capital must flow through a banking system to be leveraged into systemic financial power. Standard Oil's cash reserves, accumulated through its predatory pricing and rebate structure, became a primary source of liquidity for the major banks. This established a power asymmetry where industrial capital dictated terms to financial capital, an inversion of the traditional relationship. This is the origin of the centralized financialization of liquidity. When David Rockefeller led the expansion of Chase Manhattan, he replicated the trust's philosophy on a global scale, prioritizing international banking and loan expansion. The goal was to control the flow of credit necessary for sovereign and industrial expansion worldwide. The $35 a year tenure at Chase saw the bank establish a presence in over $70 countries, transforming the bank from a regional player into a global arbiter of capital flows. This centralized control over international liquidity acts as a contemporary form of the railroad drawback. Every transaction, every loan, every piece of global trade generates revenue for the central financial architecture. The illusion holds until it doesn't. The modern financial trap is the application of the trust-style unlimited corporate permanence via the holding company and the proliferation of new financial derivatives. The 1911 Supreme Court ruling dissolved the Standard Oil Trust into $34 constituent companies, but the capital and the organizational pattern here persisted, giving rise to companies like ExxonMobil and Chevron. These corporations, successors to the original trust, continue to leverage immense scale and deep institutional ties to banking structures. The financial trap operates through yield structure dependence. The average worker is forced to invest their savings, e.g. $401, into the very market structure that suppresses their wages, seeking yield in the same financial products that fund corporate buybacks and financial engineering, the modern equivalents of the railroad rebate. This is institutional arbitrage. Large corporations, funded by the successor banks to Rockefeller's sphere of influence, can borrow money at near zero rates, a subsidized cost of capital, which they use not for productive investment, but to increase shareholder value, e.g. buybacks. The derivative market, nominally valued in the hundreds of trillions, is the ultimate expression of the trust's original opacity. It is a financial instrument designed by and for the largest institutions to manage, shift, and profit from volatility. The very market fluctuation Rockefeller deemed a sin. This complexity ensures that the system is only comprehensible and navigable by the financial elite, creating an informational barrier to entry that is mathematically impossible for the average investor to overcome. What cannot be repaid will be rolled over, and the systemic risk is absorbed by the general economy through implicit government backstops. The system is not a platform for exchange. It is a mathematical structure designed for continuous exponential capital accumulation at the center. The vast charitable foundations, the Rockefeller Foundation, established with the family wealth, are not an escape. They are the third pillar of control, wielding social and political influence to shape the regulatory and academic environment, ensuring the structural permanence of the financial architecture. The money that services this entire perpetual motion machine comes from the productive friction of the real economy. Confidence decides who survives. The third chapter requires a forensic diagnosis of the immediate mechanisms that perpetuate this financial trap, rooted in the Rockefeller philosophy of maximizing cost saving and waste reduction by controlling the total system. For the individual, this translates into mandatory participation in the debt economy with structurally predetermined outcomes. The core function of the modern financial trap is cost capitalization. Just as Rockefeller capitalized the risk of oil exploration by controlling refining, the system capitalizes the cost of necessities, education, healthcare, housing, through the ubiquitous use of leverage. The cost of a 4-year university degree is not paid with savings, it is paid with a student loan. The non-dischargeable nature of student debt, a political carve-out, creates an almost risk-free asset for lenders, ensuring that the burden of accessing labor market participation is borne by the individual borrower over decades. The $1.7 trillion in student debt is an institutional mechanism for transferring future labor earnings directly into the financial system, preemptively suppressing capital formation by the productive class. This is reinforced by the unmandatory credit velocity. Inherent in the scoring system, the FICO score, a key determinant of access to all low-cost credit, rewards reliable indebtedness, not solvency. You are financially penalized for opting out of the credit matrix. This forces the individual to become an active, managed asset for the financial system, paying transactional fees, interest, and penalties that perpetually siphon wealth upwards. This ensures the continuous flow of small, necessary payments from the decentralized productive base to the centralized financial nexus. The financialization of infrastructure and public goods further cements the trap. Public services, like toll roads, utility monopolies, and even water systems, are often funded and managed through municipal bonds and private equity investment. This converts essential public needs into revenue streams for the financial class. Every time you pay a toll or a utility bill, a portion is diverted from the productive local economy to service the debt and generate yield for the bondholders and private fund managers, the modern successors to the trust's original investors. Markets enforce what politics avoids. The system is not merely taking your money, it is optimizing the structure in which you earn it. The rise of the gig economy and contract labor, often driven by venture capital, funded by the institutional descendants of the great trusts, converts permanent employment with benefits, a financial drain on the corporation, into flexible variable cost labor, maximum corporate efficiency. This minimizes corporate liability while maximizing the dependence of the worker on high-interest credit to bridge income gaps and manage risk. This is Rockefeller's principle of waste reduction applied directly to the labor force. The final element is the structural suppression of competing stores of value. The system operates most efficiently when all wealth is denominated in the sovereign currency, which can be managed and manipulated by the central bank. Stage 3, inflationary cleansing. Alternative stores of value, such as decentralized digital assets, are met with regulatory and institutional hostility because they represent an uncontrolled exit from the credit matrix. The only accepted escape is the purchase of financial assets controlled by the system itself, stocks, bonds. The rupture is scheduled by the numbers. The system is designed not just to make you poor, but to ensure that your every attempt to escape is tracked, monetized, or redirected back into the architecture that maintains the power asymmetry. The financial trap is not an accident of capitalism. It is the logical, perfected outcome of John D. Rockefeller's structural blueprint for centralized capital control. His genius was institutional, and his legacy is your balance sheet. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.